Yes. I can't set the poll up because you're logged in. Oh, you can do the question polls? Oh, great. Then you're set. Yeah, then let's do that. We can vote up their questions. And then we can do some of both. I'll pass it off to you for the panel. All right. And also, I have to pass it off to All right, all right, all right. Good morning, everyone. Thank you so much for coming in early in the morning. Of course, it's CGS that's chosen for you to be here early in the morning. We have an exciting day planned. I guess you all know there's an exam today at 6:30 for all of the SM 131 sections. But we have this wonderful opportunity to hear from honors students, from leaders of the Mehrotra Institute, and experts on corporate governance. So our purpose this morning in 3 separate lectures, you only have to stay for this 8 o'clock one, is to hear about corporate governance issues from our leaders and experts from the Mehrotra Institute. Professor Patricia Cortez has organized the honors students in putting together the introductory part of our discussion today. And Professor, where's Marcel Rindesbacher? There he is, leads the Mehrotra Institute. We are joined by a host of faculty who have contributed to guiding our honors students in putting together their research presentations. We are joined as well by a series of experts, each of whom will be introduced when they participate in the panel discussion. We're also joined by Chris May, Executive Director of the Mehrotra Institute. And the structure for today is we will have our honors students kick off the discussions with presentations based on the research that they've done. Then we will introduce our panelists. The honor students will ask some questions of the panelists, and then we'll open it up for group discussion. I'll keep the QR code up for the next, say, 12 minutes or so, so folks can sign in. If your camera is not working or if something is amiss and you're signing in with the QR code, just take a picture of yourself or have a friend take a picture of you, and you could email it to me. The picture should show that you're in the class at this point in time, and then you can get credit for attendance. Either way. Without any additional administrative comments to say, I get to turn things over to Professor Patricia Cortez. You have the microphone, you have the stage. Thank you. I'll even give you a clicker. Thank you so much.
Hi, everyone. So excited that you are all here. We're very excited for our honor students to present their research on corporate governance under the guidance of some of our best faculty here in the school. So we're just going to start with our first team. Come on, guys. So they're going to present for 10 minutes. And then we'll have 3 presentations of our students. And then we will have a wonderful panel.
Yeah.
Is this on? On? Is this on? Yes? Okay.
I start with the clicker. Good morning, everyone. Today, my team and I will be presenting our research on executive compensation and independent boards with the help and expertise of Professor Albuquerque, who sadly could not be with us today. We were initially drawn to this topic given the complications that tend to arise between influence and wealth and the implications it has on corporations in our society. My name is Danielle Johari.
I'm Miranda Saad.
But before we begin, it is important that we understand some of the main concepts. Board independence means that members of the board are not part of the company management. They're outsiders. This allows them to carry out more fair and objective decisions. CEO pay to performance alignment means that CEOs are awarded based on how well the company actually does, and not based on their influence or position. This leads to our question today. Does greater board independence actually improve alignment between CEO pay and company performance? The main idea starts from what is called the agency problem. Managers, the agents in this case, sometimes act out of self-interest rather than the best interest of the company and its shareholders, the principals. Rather than the best interest of the company. For example, they may increase pay or perks even if the company isn't doing well. Boards were then created to monitor this kind of behavior, and independence is supposed to make them stronger, have tighter controls, and actually be less biased. Then came the reform movement. Following a couple of corporate scandals, the government decided to step in and implement a few major changes. Two of them were the Sarbanes-Oxley Act, which worked to improve oversight and enforce more accountability. And the second was the NYSE and NASDAQ rule of 2003, which required that both boards and compensation committees be fully independent. However, we do reach the paradox, because over the years we've seen greater independence across major US companies, but we've also seen a dramatic rise in CEO pay. So what might explain that? Perhaps independence on paper may not necessarily translate to independence in practice and may not actually change any behavior. Therefore, we must look beyond the structure of a business and not just how many outsiders there are, but rather how effectively they are at monitoring, whether through challenging, questioning, or holding CEOs accountable. I'll now pass it on to Miranda to speak to us about the different perspectives that the scholars have had over the years.
Thank you, Dania.
I also wanted to mention, as we can see on the chart, CEOs with independent shares can earn around 11 million, which isn't that much of a drop compared to when they are insiders or even CEOs.
This slide introduces three different theoretical perspectives on board independence. The key idea is that scholars disagree on whether independence is actually helpful or if it just looks good on paper. So we need to understand the logic behind these three perspectives to understand and be able to evaluate board governance. The first perspective is the monitoring hypothesis. This perspective says that CEOs who are independent actually monitor board directors who are independent actually monitor CEOs more effectively and lead to a better pay according to that is more linked directly to performance. And in this case, when performance goes up, pay also goes up, and when performance goes down, pay goes down, and this is the ideal case scenario. The second view is the symbolic governance view, and this says that independence looks good on paper and formally, but may not change anything in practice. And so directors can be independent, but may still defer to CEOs or not have the necessary abilities and capabilities to be on the board. They also may just vote according to what management wants. So it shows that independence looks good on paper, but not in practice. The last view is the complementary view, and it shows that independence can't be good alone and needs accountability mechanisms to support it. For example, strong shareholder interests and active investors and institutional investors to be able to make that independence efficient. On this slide, we can see the different studies that support these mixed views. On the one hand, there are studies that show positive correlations between independence and CEO pay. A study in 2008 shows that independence, when paired with accountability, is actually very helpful. So when it's paired with shareholder interests and institutional investors, independence actually links pay to performance and reduces excessive pay. Another study shows that when a study done in 2021 shows that when boards hired independent compensation consultants, they achieved a stronger link between pay and performance, so excessive fixed pay went down. On the other hand side, negative or neutral studies done in 2008 and 2009 shows that directors may free ride with independence, so they may be independent formally, but not work hard. Another study shows that after the Sorbonne-Oxley Act, pay went down, but it didn't increase its sensitivity to performance, which means that excessive pay did go down, but at the same time, incentives didn't change and incentives stayed the same. And lastly, another study showed that independent boards increase CEO pay and increased the poorly performing CEOs turnover, but at the same time, it increased their severance package, which means that their incentives also didn't change. I'm going to pass it on to Anya to talk about the Tesla case.
Thank you, Mira. So we wanted to apply some of the empirical evidence that we saw to a case study. The first thing to note that we want to acknowledge is that this is a bit of an outlier type of case study because of the compensation plan is so huge. But we thought it got a lot of litigation attention, and we thought it would be valuable in deciding other governance standards in the future. So Tesla's compensation structure was under scrutiny in 2018 when Musk was requested and was nearly approved for a $56 billion compensation package in stock options. It was performance, not profit-based, which means that Musk could have received the compensation if he hit certain goals, even if the company lost profit. There was a growth goal of around $100 billion to $650 billion in market value, which he had to hit in order to receive his stock options. The interesting thing to note is that even though the board was seemingly independent, it was actually made up of Musk's brother, his former business companions, and himself. So he had voting rights when deciding if he should receive this package or not. Pro-alignment people to this compensation structure decided that it was very in line with Tesla's growth goals, and at the end of the day, it was still performance, even if they lost profit. Criticism said that board independence was symbolic in this case because there was no actual independence and everyone was slightly biased towards Musk. And the plan favored long-term growth over long-term stability. So if we take some of the concepts directly, we can see that symbolic independence, which was a theme in one of our our empirical research, found that directors with social and family ties to Musk dominated the board, which meant that there was weak monitoring despite what seemed like compliance to regulatory requirements. Context dependent means that there was a lack of shareholder resistance. There was no institutional, which would be a BlackRock or activist investors. They were all retail stakeholders, which means that they owned individual stocks. So they could not get together and be as effective in protesting or deciding this option. Reduced pay discipline refers to large option-based pay guarantees wealth once certain thresholds are met, even if there's no profit gained. And then temporary reform effects focuses on board reform rhetoric, whereas pay magnitude remains unprecedented. Overall, we see that the Tesla case blurs alignment and legitimacy of independence and shows how it can become symbolic over than actualized. So the key takeaways that we want to hit is that independence does not equal impartiality. True oversight requires accountability and actual independence, so people who are unbiased on your boards. Tesla's case is a key example of this, and that context is everything. independence only matters when you have proper structure and proper constitutions in place, and that this project examines when board independence has real oversight. In fact, Tesla was just was just in Wall Street Journal for Elon Musk being potentially approved for a $1 trillion pay package following these similar structures of performance rather than profit-based. He voted for, obviously, and there was a 75% approval. So unless it gets tied up in the courts, it will most likely pass. The central question that we want to continue to examine is that how can we design governance structures beyond symbolic compliance and to ensure that there's substantive accountability in CEO compensation packages. Thank you, guys.
Nicely done. Perfectly on the minute.
We have now the next team.
Wait, is there a clicker or just use this? Okay. Good morning, everyone. Thank you so much for being here today. Today, my team are going to talk about board composition and diversity, more specifically, specialist directors and their role in the boardroom. My name is Damia Kimbade.
My name's Tina Huang.
I'm Ava Cosgrove.
And this is our agenda for today. We're going to start with an introduction, understand our background and motivation, then go into our research, and then finally our case study and conclusion.
All right, so before we explore whether adding specialists to boards actually makes them more effective, I thought we should start off with an understanding of what boards actually do and how their landscape has changed over time. So the board of directors oversees a company's key decisions and strategy. They represent stakeholders and ensure accountability. They essentially serve as a bridge between management and stakeholder interest. Traditionally, boards were comprised of experienced generalists who were people with broad business acumen who could advise and weigh in on issues from finance to operations. And while this business model worked for a long time, while businesses were slow-paced and challenges were less complex, today's businesses face far more complex, interrelated challenges, which introduces the need for specialists. These challenges can be climate change, corporate ethics, as well as societal expectations. So specialists are directors with a deeper expertise in their subject area who can provide targeted advice on their domains, because now the directors are no longer required just to evaluate quarterly performance. They're required to, They're required to anticipate long-term business risks as well as navigate crises and global issues that cross over multiple domains. So this growing mismatch between what specialists were or directors were designed to do and what they're expected to do today drives our question for our presentation, which is whether adding specialists that are experts in technology, DEI, and sustainability can address this growing complexity.
The existing literature on this topic demonstrates that both specialists and generalists have their strengths and their limits. Beginning with the benefits of specialization, specialists tend to make more R&D focused investments and can improve profitability. When their knowledge is properly integrated across the board, they can also increase creativity and enhance decision quality. However, there are several risks to over-specialization. Adding specialists without strategy or without the ability to properly share their knowledge across the board can lead to inefficient group dynamics, such as authority bias, where other board members kind of defer to the decision of the expert rather than taking the time to learn from them and come to their own conclusion. And additionally, there may be symbolic hires that don't add real value to the board. They just have the credentials. And some specialists are isolated when it comes to the topic of AI as they struggle to share their knowledge with other board members. Generalists, on the other hand, can encourage innovation as they have broader experience and they enhance cross-functional teamwork through their broader experiences. However, a generalist board also does not guarantee success. Their strengths are most apparent when the collaboration is present.
So moving on to where specialists actually make a difference, we decided to focus on 3 challenge areas. Specialists are adding values to boards where they're facing complex challenges that are fast-paced, stakeholder-sensitive, and highly technical. So starting off with ESG, specialists here are able to navigate disclosure rulings, sustainability reporting, and help boards reduce the risk of greenwashing. And then moving on to tech, specialists that have backgrounds in cybersecurity and AI are able to help boards navigate digital risk and see risk a lot faster than generalists would. And then finally, with DEI, specialists are able to make boards more culturally aware and strengthen accountability so that every decision they make is both fair and inclusive. But it's not only about the expertise that they have, it's also who they know in the industry. They're able to help boards through connecting them with their network as well.
The overall intention between adding specialists to boards is positive. Boards want to strengthen oversight while managing risk better, making better informed decisions. However, we're seeing that specialists can sometimes narrow this discussion rather than broadening it. As Ava mentioned before, sometimes when a director is called upon as an expert, other directors in the group may just defer to them rather than critically engaging in discussions about their domain, and this can lead to expert reliance trap. Over time, this can also lead to siloed oversight, which is when discussions only are confined to one person's domain, and this can reduce overall collaboration within the board. Another symptom of specialists is limited board impact. So sometimes when an expert in a field, maybe technology, may feel that they don't have value in other domains to advise in, they may just limit themselves to their own domain, limiting overall board impact. Overall, while specialization may seem like the logical approach to addressing this complexity in business, we're seeing that sometimes specialization can reduce adaptation and also limit the effectiveness that they are meant to improve.
To further our research, we decided to look into oil and gas company ExxonMobil. In 2021, ExxonMobil added 3 experts in renewable energy and capital reallocation to their board after facing pressure from hedge fund engine number 1 to make more environmentally conscious decisions, which as an oil and gas company isn't generally in their business model. But the outcomes to electing these directors was that they were able to increase their climate disclosures, as well as develop plans to reduce their Scope 1 and Scope 2 emissions. An important takeaway from this case is that the specialists had not only the knowledge, but also the incentives to prioritize environmental consciousness, where this has been underemphasized in the past. Additionally, the ExxonMobil's board is still made up of many strategic and financial generalists that were important in these decision makings, demonstrating that collaboration between specialists and generalists is very important for a company to move forward and actually make improvements across their board.
So as companies grow larger and influence every part of our society, the demand for specialists isn't going to go away. So using everything that we've spoken about today, here's how to implement specialists onto board both effectively and constructively. So starting off with firms, this is about hiring fewer but smarter specialists, making sure that they're actually integrated into the board and decision making and not just added on as a symbol. For investors and regulators, it's all about transparency, understanding who these directors are, what their role is, and preventing board washing. And then finally, for future managers like ourselves, it's about understanding the balance of specialists and generalists. Understanding that specialists alone does not guarantee success, but rather a balance of specialists and generalists is what will help collaboration and help decision making.
Overall, we found that specialists are very important when it comes to these technical, fast-changing, or stakeholder-sensitive issues like ESG or the rapid development of AI. And generalists can be beneficial to connect the dots and bring strategic perspective and encourage collaboration across board members. We found that there needs to be a balance between specialists and generalists, and that the future of governance depends
not on credentials, but more on adaptive leadership and the ability of the board to collaborate and share their knowledge and experience. Thank you for listening, and a special thank you to our honors advisor, Professor Cortez, and our faculty advisor, Professor Shapira. Thank you.
Hello. Hi everyone, thank you for your time today. Our team will be discussing common ownership and how it impacts competition and innovation. My name is Lauren.
My name is Jocelyn.
And my name is Jin Feng.
And we also have our wonderful faculty advisors, Professor Leccese and Professor Cortez as well.
So starting out, we wanted to provide a depiction of how common ownership is. As you can see behind me, this is a high-profile example including Apple and Google, and highlighted in yellow right there is Eric Schmidt, who is the chairman and CEO of Google, and at the same time was also sat on the board of Apple. Apple and Google had entered an agreement that they would refrain from poaching each other's employees, and that right there is something that we'll discuss more later on, but it shows how this relationship between this director specifically and interlocking directors, and that connection between these corporations leads to non-competitive behavior.
And next, let's look at an example in the passive investors. So a great example where we can look is the airline industry. Now, across all of its funds, BlackRock holds a significant stake across 4 major US airlines: Southwest, Delta, United, and JetBlue. We actually found that post-merger ticket prices rose between 3 to 7%, and there was less route competition in routes where there was common ownership. Now, airlines compete fiercely for passengers, but behind the scenes, the same giant passive investor holds a significant stake in it all. And this is what's called common ownership, and it can influence how much competition and innovation actually happens. We want to know, does common ownership encourage collaboration, or does it reduce competition and slow innovation? Now, this can have a significant impact across all industries. Common ownership is actually more common than you think. From VC-backed startups to global institutions, it may be the invisible force shaping how fast or slow industries build upon current products or innovate new ones. We'll be discussing a couple different topics, so we wanted to provide some context. We've already gone over common ownership, so now let's take a look at antitrust. This focuses on promoting fair competition. We want to ensure that one firm does not have a dominant amount of market power, preventing other firms to compete. A great example where we can look at is in 1911 with the Standard Oil Company. This company at that time was a monopoly, but after US government interference, broke into 34 individual firms. Next, interlocking directors. This focuses on individuals who serve on the board as directors for 2 or more firms. And lastly, innovation efficiency, the process of creating a new product or improving a current one by improving the better results that are demonstrated and the inputs that are inputted.
Yeah, so now we'll walk you through how it actually affects innovation and as well as competition with shared investors. So first off, we have increase in innovation. So when firms have shared investors, they usually encourage firms to collaborate and share knowledge and resources among different firms. And we can often see this happen throughout tech and software industries where innovation really increases greater efficiency and shared resources. On the other hand, we have innovation that can decline, leading to less competition. Shared investors can actually reduce incentives for firms to compete aggressively to gain market share. And along with this, also includes sensitive information being leaking to other competing firms within the same industries. And this tends to be a problem mostly in pharmaceutical companies, where competition really drives that innovation. So overall, understanding how share investors affect innovation and competition can really help us understand how these firms are going with their strategic decision. And moving on is looking how these, really understanding how these underlying motivations of these share investors can actually impact how the firm is operated and how they moved in the future. First off, we have the passive fund index. So these are the type of investors who are, more laid off, and they like to highly diversify their portfolios. So they're more they put more value onto the stability of the market and their portfolio, so they like to diversify their firms in their portfolios. So an example of this will be BlackRock that Lauren mentioned before, the airline industry. So BlackRock own common ownership equity in most of these airline firms, but they wouldn't go to them personally to actually conduct any strategic decisions with them or involved any of the direct price wars. On the other hand, we have the active, or known as the activist investors. So these type of people, they like to pick and choose their stocks. So they like to focus on one specific firm to actually help them grow and gain market share and compete with other firms. An example of this would be SoftBank. They are really involved in the strategic decisions made in the management firms of the companies that they invest in. So an example of this would be riding platform gig economy, such as Uber, Didi, Grab. So in 2016, Uber actually backed out of the Chinese market for Didi to dominate the share in the market. So this reduces the global competition. And now Jocelyn will be walking through how it actually applies in the real world and how these share investors really blur that legal line between the firm and how they operate.
So there are legal measures set in place to prevent collusion and this non-competitive behavior. One of them is Section 8 of the Clayton Act, which prohibits an individual from sitting on boards that are competing partner or competing firms. And so that leads to the question of, given that there's that rule set in place, why is it that we don't see very much or any enforcement of this regulation that against interlocking directors? And so one of the things to consider is that the Federal Trade Commission and the Department of Justice, which are the agencies that enforce this policy, they also consider as well that the directors of these firms are well networked and therefore have expertise knowledge within their industries for the firms that they sit on. And therefore, that is why there's this sort of issue when it comes to Section 8 and how it has the rule is, there's a distinction between making sure that the rule isn't too narrow and also too broad, because if it is too narrow, it'll permit interlocks between corporations that do meaningfully compete, and if it is too broad, it restricts corporations that do not meaningfully compete. And that's why we can see that one of the things is that common ownership, there isn't very much regulation within that matter or that discussion, because there aren't quite yet the laws that are enforced to cover this matter. So then one of the case studies that we had reviewed was with BlackRock and Barclays, and specifically what we had talked about in the past or earlier, how active investors have a really big impact on the innovation within their firm because they are more directly involved. We wanted to see if that same thing applies with passive investors, and so this study was when BlackRock had merged with Barclays and had acquired all the firms under Barclays' portfolio, and with that, it wanted to see whether common ownership had an impact or a causal effect on innovation. And so the study found that there was limited evidence to prove that there was a causal effect between common ownership and innovation. But with that in mind, we also have to take into consideration the nature of the investor and the fact that they aren't directly interacting with the firms as active investors might. And so the key takeaway from the case study was that innovation is dependent on multiple factors, including the investor type and where the industry is, and as well as the firm structure, which all have a play in the role. So I'll hand it back to Jinfeng to discuss our final takeaways.
Yeah, so one of the main biggest key takeaway that we want you to take note of from our discussion is that most share investors can actually result in social benefits for our community. So an example of this would be in our pharmaceutical companies and industry. While it provides funding, but it can also help actively shape how these firms operate. And we can see from past research and studies have shown that there's a higher chance of a drug being completed per dollar spent on R&D. So this can really drive that innovation. And to recap of our presentation, we want you to take note of how this actually helps, how share ownership can not only be a powerful force for progress, but it can also become a shortfall. And we want you to leave with the question of how it actually happens in the future and how it can drive innovation or competition. Thank you everyone for your attention, and yeah.
You're special.
Hello, everyone. First, thank you to our amazing panelists for being here today. Just to quickly introduce everyone on stage. So we have Professor Roy Shapira, visiting professor at the Questrom School of Business and senior fellow at Harvard Law School and professor of law at Reichman University in Israel. And then we have Mr. Kevin McGovern, board member and president of the New England chapter of National Association of Corporate Directors, and Mr. John Powers, senior vice president and associate general counsel at Citizens Bank. Together, they represent the academic, consulting, and corporate perspectives of how governance actually works in practice. So a starting question directed to the three of you is, from your perspective, scholar, consultant, and corporate leader, what do you think good governance really means in practice today? Has its meaning changed as firms face new pressures from investors, employees, and society?
Can we go first? Well, first of all, good morning. It's great to be here and see so many bright-eyed students at 8 o'clock on a Monday morning. So thank you for coming. I think in many respects, board governance has not changed. Whether you speak about it from the perspective of the board providing a credible challenge, the board being responsible, as you saw in some of the slides, for strategy and the ongoing performance of the company. And then lastly, what wasn't on the slides, at least what I saw, was the board really being responsible for one main activity, which is the hiring of the CEO and determining her or his pay, and then ultimately deciding when that CEO has to go and someone else can take over. So those have been sort of the baseline responsibilities, in my judgment, of board members for a long time. I think what has changed, and has changed meaningfully in the last 2 decades, is who the board is really acting on behalf of. Because for a long time, it was just the shareholders, the owners of the company, whether it was a private company or a public company. That was really the core focus of the board. And I think over the last 20, 25 years, certainly since Sarbanes-Oxley, that has expanded significantly to include stakeholders. And we heard that this morning from all of the presenters, I believe, whether it's customers, employees, suppliers, regulators. The board now really does have to take into consideration not just the share price and the performance of the company, but many others who really have a say now, whether it be through media, social media, et cetera, how that company is perceived and ultimately may reflect on its performance.
Yeah, definitely to build on what Kevin said. Definitely stakeholder governance is the new trend. The board has to take into account not just the shareholders, but also, and it goes beyond maximizing profit, you know? Yep. They have to think about the communities they work in, they serve. Also, transparency, another big trend going on. Shareholders, stakeholders want to see more. They want more information. They want to know how decisions are made, that kind of thing, definitely.
Yeah.
So I guess I'll echo Kevin and Jay, or maybe boil it down. Does that not go? All right. So maybe boil it down. I guess corporate governance will always be about two words, power and accountability. So who has the authority to make decisions to steer this giant ship of a large business company, and who and how are they being answerable to? Okay, so that hasn't changed, wouldn't change, and what changed maybe is just the types of pressure, the environment that they operate in the sense that we traditionally thought of accountability in corporate governance as vertical. You have the managers, they make the day-to-day decisions, and they're answerable to the board of directors, as we heard in the presentations. The board can hire, can fire the CEO, can design the executive pay, and the board of directors supposedly is answerable to the shareholders, and they can decide to hire or fire directors if they don't deliver the results. But in the past recent years, or a decade or so, we start thinking about accountability as multi-directional. So things that Kevin and Jay mentioned, we have in some companies you have to be answerable to the employees, in some you have to be answerable to socially minded customers, in some there's more regulatory involvement in the past decade or so. So I guess that's the point. And the companies that were quicker to realize this change in the accountability map or accountability metrics are kind of the companies that you now see score highly on the trustworthiness metrics and being more resilient and so on.
You know, if I can add one last thing, I think a developing situation, and Jay, you may know more about this given your directorship or what you do with citizens, but for a long time, the state of Delaware was seen as the safest, kind of most corporate-friendly state to incorporate in, had a long case history of corporate governance and case law, and that's significantly changing. And I think boards have to think about, you know, do they still incorporate in Delaware? One of the presentations, maybe in both, two of them, talked about Tesla. Tesla recently moved from being incorporated in Delaware to Texas because they see Texas as a more corporate-friendly state. And now states are competing for where companies are incorporated based on how they're constructing their corporate law. And I think that's a really interesting development in governance right now, because where you want to be incorporated is something I don't really think companies thought a lot about as much as they are today.
No, Delaware was the default, definitely the default, but like you said, Texas, Nevada, making big moves to try to attract more corporate residency, for lack of a better term. Yeah, no, you have to think about not only are the laws of the state going to be more corporate friendly, but also the case law. If you get sued in a shareholder action, hopefully that never happens, but you know, you're looking down a multi-billion-dollar problem. You want to make sure you have case law that's going to be friendly to you, that kind of thing. So definitely.
Thank you guys for your perspectives on that. I know a lot of our 131 students in this room are learning about the difference between stakeholder and shareholder management and impact. So it's good to hear about that. I'm going to ask some individual questions now. So for Professor Shapira, I'm curious to hear your thoughts on how boards can ensure that specialist expertise is actually integrated into decisions and not just confined to one committee.
Right. Okay. Right. So I think in the presentation, the second presentation that we have with Iva and Tina and Dami, we heard about the kind of the disadvantages of having specialists on the board. You bring in specialists, you don't want to bring the cyber expert or the climate expert or the AI expert. You don't want just to put them in one committee and say, okay, you do your thing and we keep on doing our things. You want to, if you bring in specialists, if you want to add those value of people with narrow subject matter expertise, you want to embed them into the agenda setting and discussions in the board. You want them to be kind of translators of these complex issues to the entire board, not technicians. You want them to be able to learn and think together and deliberate together with the other board members who have much very broader set of experience and expertise about those issues. You want them to enhance deliberations rather than kind of replace deliberation. So the extent that you manage to do it, you can escape the things that the second team talked about, such as authority bias. Okay, I'm very experienced in business, but I don't know much about AI, and here comes Jay, and he's an expert in AI, and I will just defer to his judgment. If you manage to embed them, you will reap the benefits of having the specialist. If you don't, and if you just let them do their things, it will not improve the effectiveness of board discussions.
Thank you for that. And then a question for Mr. McGovern, kind of related to, I know you mentioned the Tesla case study as well. Given your experience in board advisory and risk management, what governance structures or practices do you think independent boards need to adopt, especially in firms undergoing major transformation or under heavy regulatory pressure, to ensure that pay for performance is guaranteed?
Well, I think we heard a lot about pay and performance here. I think, there's a process piece to this and there's more of a contextual piece to this, right? So, in the annual processes, the actual awarding of stock options, restricted units, whatever they may be, is a process unto itself. And depending on things like, how long over a period of time do those vest? Do they continue to be vesting based on hitting actual performance targets? What are those performance targets? Are they earnings? Are they sales? Are they retention of key employees? As the CEO, her or his package probably has lots of different components to it in terms of how that pay is determined. Some of them may be more short-term, some of them may be more long-term. You think about where is the company today? So, I love to think about, with all deference to Jay here, Brian Moynihan of Bank of America. When Brian took over Bank of America in January of 2010 or so, the bank was in really bad shape. They had bought Merrill Lynch, and Merrill Lynch was failing. They had bought Countrywide Mortgage, and Countrywide, many people would say, was one of the primary causes of what happened with the financial crisis in 2008. And the bank was largely considered to be on the brink of failing on a number of occasions. And Brian and his leadership team put together a very long-term plan about how to take this bank out of the trouble it was in. It took about a decade. And so you have to think about how do you incentivize that CEO, and at the time his team, to stick around and execute the plan that they had for turning Bank of America around. And over the course of time, the bank went up and down for about the first 5 or 6 years. If you look at the history, there were moments in time when that bank's stock went up and then went down, and went up and went down. There were lots of issues around the mortgage crisis and everything. So I think when you think about pay for performance and how it works, you really have to understand a couple of things in unison: where the company is and the timeline for the performance itself. How are you using performance pay, whether it's stock options, restricted units, incentive pay, whatever it might be, to make sure that the incentives are aligned with where you are, but also where you expect that performance to go in what time frame. It's pretty complicated.
It seems very complicated. I'm sure, in relation to our Tesla case study as well, I think a heavy stock option plan relating to performance goals is very much in line with Tesla's goals to really capture more of the market and shift towards all their AI vehicles and things like that.
Yeah. I mean, we heard a little bit about, and we talked about this, about Elon Musk's recent pay for performance. It's $1 trillion, right? But the company itself has to hit, is it an $8 trillion market cap? Something like that? It's a crazy, I mean, these are almost out of reach numbers that some could say, if he's able to do this, and of course it's not him alone, does he deserve that kind of compensation? I mean, it's a real question. And as we heard, a majority of the shareholders voted for it last week.
Our CEO has an actual scorecard, so he gets graded by the board as the year goes on as to how he's hitting his marks, his performance, and his pay can range from 9 million to 15 million, depending on how things work out for the bank, tied to performance. So,
My next question is actually for you, Mr. Powers. So from your seat supporting Citizens Board of Directors, what kind of questions or concerns do directors raise when ownership becomes more concentrated amongst common institutional investors?
Yeah, so like BlackRock was up on the screen. BlackRock owns a piece of pretty much every bank, I think, owns a piece of everything. And, but, we have actual, and people in this room might be involved in it down the line. We have an actual investor relations team that reaches out to our large, 3%, 4% owners. And we do, regular calls with them. We talk, I sit in on those calls and sometimes in case they have a governance question, because investors are very interested in governance these days. But yeah, we do check-ins with our large, investors to make sure that they're happy. They're not going to dump their position, these kinds of things. So, yeah. I mean, also the thing I want to, Glass Lewis, which advises investment funds on, say, on pay, board composition. They're a very powerful force right now in the world, in public companies. And you've dealt with them, I'm sure. Yeah. And, they can, if they don't like the pay package that's being proposed for, say, the CEO, they can basically advise all the BlackRocks in the world saying, no, we don't like this, vote against it. So they're a very powerful force right now in that kind of thing.
That's interesting to hear. Okay, so we're going to shift to audience questions now. So let's see. Yes, we have questions. I don't know the password. If everyone could submit questions to the link above, that would be great. I think we have some. Yes. Okay. So one of the questions we have is, how do you feel about golden shares or recent federal intervention in private business?
Well, I'll take the second half of that question. I think it's actually part of my answer to how has governance changed. One of the things I wrote down was government getting involved in the U.S. anyway, because it's more prevalent in other parts of the world, but in the U.S. anyway, the government getting involved in ownership of private and public companies. So we saw what happened with Intel recently, what's happening with NVIDIA and their ability to sell chips to China, theoretically, government taking a 15% stake of their revenue. Personally, I think it really does change the underpinnings of the capital markets in the US, because companies up until recently were largely free to operate how they saw fit without worrying about how the government would see whatever steps they decided to take, whether they wanted to build new products, enter new markets, whatever it might be. That's changing, and I think whether that's a trend or whether it's just a longer-term trend or just a current outcome of the current administration is something I think we have to watch carefully, because government ownership of corporations does change how they behave. And I just don't think, I think the evidence is pretty clear. So what happens in the US regarding that is something I think we have to watch, and it's worrisome to me.
Go back to the first question that we asked. So this changes things, right? If you're a board of directors, now you
Yeah.
have to think not just about shareholders, not just about stakeholders, government interest, national interest. How do you think about those things? How do you combine them?
Well, I mean, my industry is the most regulated industry in the U.S. So we deal with, the Fed, the SEC, the OCC. And does that change the dynamic if suddenly the government has a 5% stake, 10% stake in our bank? Do we get preferential treatment? Because I'm here to tell you, enforcement is not always clear across the board. I mean, it's very discretionary, yeah. So would we get, favorable treatment from the government? Should they, and these kinds of things? Do they get special shares? Do they get special voting rights? How does that work? So, yeah, it's a big question. And I mean, it's moving away from a sort of a free market model now, too. So is that good or bad? I don't know.
Kind of along what you said about your industry being the most regulated, this is a question for all three of you. But as regulatory scrutiny, especially in financial institutions, strengthens, we wonder if it strengthens genuine board oversight or if it kind of turns independence into like a compliance checkbox.
So part of the reason that there's so much emphasis on board oversight these days is the rise of the compliance movement and industry starting from the 90s. What happened is that regulators across many fields, not just in banking, not just financial institutions, they started realizing that companies are growing and growing and become more complex, and the regulators cannot be all-encompassing and monitor, and they don't have enough resources to do all the enforcement and to monitor everything that's going on. So what they started doing is they started distributing these carrots and sticks kind of system of telling companies, you'll be the one doing the internal governance, you'll be the one monitoring your employees, and then report to us or solve things inside if something bad happens. So that's the shift towards compliance, and maybe some of you will even work in compliance departments because these have balloons and companies are spending billions of dollars on these departments. Now, so that's the 90s. Now, somewhere in the 2000s, 2010s, these same regulators started realizing that sometimes this just incentivizes like a check-the-box compliance or cosmetic compliance, where companies will go about a certain checklist, but it doesn't mean that they actually affected their behavior. So this is when regulators, again, in banking you see it a lot, but also in other areas, started demanding, or courts started demanding, boards' involvement. Okay, when you think about it, it makes sense because like user privacy and cybersecurity, okay, or financial adequacy so we don't have any banks collapsing, or AI bias. All these issues are first-order issues. And we want to make sure to elevate them to the highest tier of governance inside the company, which is the board. We want to make sure that companies buy in. But then the problem becomes the board of directors is like 10 people, and they meet 8 times a year. Right, and they can only do this much, okay? And when you put on their plate, you have to do oversight of AI bias and oversight of cybersecurity and oversight of climate change. And by the way, also the regular things like succession planning and hiring and firing the CEO and ensuring the accuracy of financial reporting, then you get into a problem of bandwidth. And I'm not sure that even the best, think about all the presentations that we've heard, even if they're the most independent directors and most expert directors, it doesn't necessarily mean that they will be able to do all those things simply because they are tasked with too many responsibilities to fit into one agenda. So I'm just the size and complexity of business firms are stretching those traditional models of governance.
Well, a couple of years ago, 2 years ago, Silicon Valley Bank imploded, and that was a very public thing. And one of the takeaways from that, the FDIC did a sort of an autopsy on what happened. And they actually admitted we should have been paying more attention. You've got a bank that tripled in size in 2 years, 3 years. Yeah. And, that increases the risk. But in my world, we have a duty to police ourselves. We have a duty to self-report. If we find a problem, we fix it, we report it to our regulators, the OCC, the Fed, and we usually get points, good guy points for, you know, turning ourselves in, you know. But yeah, definitely, it was funny, after Silicon Valley Bank failed, the top 50 banks in the country all got examined on liquidity management, right? Yeah, your guys were involved in that. So, and Deloitte was right there with us, making sure that we were, his company is our auditor. We use Deloitte and Touche.
My former firm.
Your former firm.
Now retired.
Oh.
Recently.
Yeah. But yeah, no, there were waves of, you know, these things tend to come in waves. Usually something bad has to happen, and then the regulatory environment gets much tighter, so.
Donnie, if I could just one thing, I think it's also important to understand different regulators, federal regulators, govern differently. So by and large, the banking regulators that Jay works with, their whole purpose is safety and soundness of the banking system. And there's a term called prudential supervision, prudential regulation that they talk about. They don't want banks to fail because that's where your money is. Look at the SEC is all about investor protection. So they're not worried about the safety and soundness of the system. They want to make sure that as an investor, when you give a company your money, when you give a mutual fund like BlackRock your money, that it is treated safely and it is treated fairly. They're much more transactional. They're much more about taking cases and going after individuals or companies that they think have violated the law around investor protection. When you look at the FTC, they're more about trade and competition and fairness amongst company and anti-competitive behavior. So very different perspectives by the different regulators, which make them act differently, and I think hold boards of directors responsible for different kinds of behavior and oversight than you see. That's not all the same.
Kind of in line with that, someone is asking what qualities and capabilities are most critical in selecting a board director?
Well, I'll go first if you don't mind. So appreciating what was on the board behind us, what the presentation was about specialists, I still think that a smart generalist is the most valuable person to have on a board. Because I think, and you all see this amongst yourselves, right? A smart individual who listens and asks good questions can learn a lot. I think the most important factor of a board being effective is, do they understand the business? You can hire a lot of the specialists that we talked about today, though I do think that finance capability and technology capability are absolutely required on a board today. Deep understanding of cyber, deep understanding of AI, deep understanding of finance and planning and how to read financial reports. I think that has to be resident on every board. But a lot of the other specialists, the board can hire and bring in and have them present to the board. Now, the problem is that when that specialist leaves the room, a lot of the knowledge leaves the room, and when you need them in a minute, you can't always get them back. But I think that by and large, really well-run boards have very smart people who understand the business and can ask the right kinds of questions of the CEO and their management team to make sure that the company is being managed and operated in the right way to be successful.
Just to add something, to me, and what Kevin started with, maybe the most important trait is knowing how to ask good questions and being willing to ask good questions. And in a way, this is like being a good director, and correct me guys if you think I'm wrong, is like being good at using ChatGPT. It's like about prompt engineering. You have to process information, you have to feed the right question. Once you get the answer, you have to process the answer, maybe feed it back, ping pong a little bit. So that's kind of a lot of, especially in today's world, 2025, a lot of complexity. Process the information, be willing to ask the question, and know how to ask the right question.
I think you're on the mark there with asking the question. Board challenge. I mean, the job of the board is to challenge management, and beat up on management. I sit in 8-hour board meetings. It gets contentious. The board does, and having smart people on the board who are willing to challenge management, saying, well, what did you mean? What do you mean by that? That kind of thing. So having a base expertise, obviously in finance, some tech, right, is helpful, but ChatGPT does help. Yeah, no, I mean, after the financial crisis of 2007, 2008, the regulators took a long look at the boards of directors. They were saying, what were you guys doing when you were greenlighting all of these risky financial products, And yeah, so I think after, the financial crisis, you have a lot more focus on what is the board doing? Are they challenging management? Are they putting forth ideas? That kind of thing. Yeah.
Thank you for that. While we're on the topic of who should be on a board, someone is asking, I just lost the question. There's been a persistent push for diversity of members on corporate boards. Does this yield benefits? What's the evidence, and is it equivocal?
So to me, and it's simple, it's not just about Boardroom, it's in many other facets of the markets that you guys will join, is to look beyond the numbers, okay? So I'm coming from law school, so when you sit with law students and they sit in an auditorium like that, they fret about the firms, the law firms that are going to join, right? And in the past decade, many of those top law firms started advertising their diversity gains. Come work for us because for us diversity matters, and look, like just in the past decade, we only had like 15% female partners, and now we have 50% female partners. But when you do the studies, when you do the deep dive, you realize that not all partnerships and not all practices are created equal. Some are more prestigious, some are more leadership positions, and when you check these positions, you see that it's still fairly concentrated among male. So kind of similar things happen in Boardroom. So boardrooms of the top companies, they moved from just 15%, I'm talking just gender diversity now, 15% female to like around 35% female directors right now. But that, the influence of female directors within the boardrooms hasn't concomitantly increased. Because again, not all board roles are created equal. There's a difference between being on a certain committee, like an audit committee, and not being there, chairing the committee and not chairing the committee, being the chair of the board who gets to set the agenda and not setting the agenda. So that's kind of the beyond the number theme. Diversity matters if it's about more than just the numbers, more than just representation. It's also the participation. It's also the influence, who gets to speak and who is being heard.
Yeah, I mean, we talked about stakeholder, governance. And now you've got a more diverse group of people that you're trying to, keep in mind and be conscious of. So I think, and the investors want to see more diverse boards. They want to see different perspectives, this kind of thing. They not only look at how many women, how many people of color, they look at what are the expertise of the board members. We have people, with tech backgrounds, we have people with private equity backgrounds, a bunch of retired bankers, But again, there's, especially with institutional investors like the BlackRocks, they want to see what, who's managing the management kind of thing.
I'll just add one thing. I think it was embedded in what Jay was just saying. I think it's very important. Diversity for diversity's sake is I think, not the right answer. But to have a board that is diverse enough so that the company can get the benefit of those perspectives, whether you want to move into a new market and a board member can help explain what that market might look like, whether it's a geographic market, a race-based market, whatever it might be, right? So, or it could be an age-based market, right? Just making sure that your board really does understand, have enough diversity to understand and help the company get to where it's going, I think is one of the primary arguments for why diverse boards, and the statistics prove this, that diverse boards companies that have diverse boards do perform better than those that don't. They're just more prepared, they're ready.
I wonder if this diversity present on boards is also in line with like representing consumers. One of the questions being asked is that you mentioned that regulators who represent the investors and the banking system as a whole, how important are regulators that represent consumers, employees, and society?
How focused are they on?
How important are regulators?
Very important, I think. I mean, there's always a debate in my world as to, well, how much regulation is too much regulation, right? Because if you overregulate an industry, it can kill innovation, it can, stifle creativity and all that. At the same time, you have every 20 years or so, you have a bad situation that happens in the financial markets. So where's the balance, right? And I think the regulators now are more conscious of, what they call human capital. How are your employees being treated? Shareholder rights, another one. They want, shareholders want more transparency. They want more rights to have a say in how the companies run, these kinds of things, yeah.
Last question. Looking ahead, what do you see as the biggest governance challenge for firms in the next decade, and how might boards need to evolve to meet it?
I think that this shift in technology is the biggest challenge for boards. Understanding artificial intelligence, agentic AI, generative AI, the impact that that's going to have, particularly for consumer products companies, I think is a very big challenge, and boards have got to, members of boards have got to stay current and educated on the shifting landscape around technology and how that's impacting their organizations.
I think so. Kevin already covered the must angle of technology, so I'll just go back to something that we mentioned like 15 minutes ago. I think the biggest challenge for boards would be bandwidth, in a sense that we can talk about all those issues. They must discuss geopolitics, they must discuss climate, they must discuss technology. And my guess is that at some point, boards will have to move from this kind of meeting 8 times a year, backward-looking monitoring, to a more continuously adaptive institution that has those dashboards that keep being updated each day, in which case, and Kevin and Jay, you guys know it very well, it kind of challenges the old adage of noses in, fingers out. We want them to engage in oversight, we want them to not to micromanage. When the bandwidth is like that, and you have to do everything all the time, all at once, you put your fingers in inevitably.
Change management's a huge challenge because to build on what you said, the velocity of change with agentic AI and everything else happening in the tech space, everyone's migrating to the cloud. Well, it's only as good as your data. Well, we have to clean up the data. So you're changing things rapidly within the organization. Things break. Banks have this happen. We're doing too much change at once. Suddenly, our mobile banking went down or something like that. So that's going to be, I think, the biggest, in my world, that's the biggest challenge is how do you manage all this stuff going on? You want to stay competitive. You want to, we're the 11th largest bank in the country. We want to keep up with the Bank of America's and the JP Morgans, right? Well, we have to do that without tripping over our own shoelaces. So that's the problem.
Thank you so much for that. I think this has been a super insightful conversation for all the students in the room. Please, if we could give our amazing panelists a round of applause.
And I'd like to conclude by thanking our panelists, by thanking our honors students, by thanking the leaders of the Mehrotra Institute, Patricia Cortez, for leading our honors students. As you know, the content from today won't be on exam number 2, but it will be for sure on exam number 3. And so thank you very much for your attention and for your interest. Thanks, everyone.
Let me know. I always do. Thank you. Good moderator.
Marcel, that was great.